Hi there, I'm Sashi Subram Krishna and welcome to my course Macroeconomics, a Modern Money Theory Perspective. We are in part 1 of the course Macroeconomics and Money. In lecture 25, we will discuss an example of T accounts. Let us see using a very simple example how a transaction would affect the T accounts of entities. Suppose I, Sashi, buy a car from Tom on credit for $100. This would affect both my T account as well as Tom's T account. The car enters my balance sheet as an asset and is worth $100. It no longer exists on Tom's balance sheet because he has sold it to me, but this appears as an increase in net worth to Tom by $100. The loan itself, which is a financial liability to me of $100, appears as a financial asset to Tom of $100. So this is the first transaction when I buy a car from Tom. As we can see, in my T account, the car is an increase in assets and my liabilities have also increased by $100. In the case of Tom, he has an asset now, a financial asset, which is the loan he has extended to me, while his liabilities have increased by $100, his net worth. This is what Tom, the entity, owes Tom, the person. Now suppose I repay the loan to Tom in cash with a $10 interest payment. How would this transaction now affect our T accounts? Beginning with the cash outflow, that is a decrease in assets for me of $110. At the same time, my liabilities to Tom have now been eliminated since I've repaid the loan, and therefore there's a decrease in liabilities of $100. The cash payment now appears in Tom's T account, showing an increase in his assets by $110. However, at the same time, the loan, which was an asset to him, no longer exists because I have repaid it to him, and therefore it's a decrease in assets of $100. It's clear now that through this transaction, our net worths have been affected. Since I have lost assets of 110, but my liabilities have decreased only by $100, my net worth has decreased by 10. Tom, on the other hand, gets an asset of 110, which is cash, but loses another asset of only $100, and therefore his net worth increases by $10. Just one point. This net worth, which appears in my T account of minus 10 or negative 10, does not mean I am insolvent, because this is only a T account and not the balance sheet itself. So if I had a net worth of anything more than $10, that net worth would now be reduced by $10 and could still well be positive, and therefore there is no need that I have become insolvent on account of this transaction. Let me reiterate a few learnings from this simple example. The first is that if we net all the T accounts, the car, which is a physical asset, remains in only my books of accounts. It does not appear as a corresponding liability in Tom's books of accounts, because a physical asset does not have a corresponding physical liability. The loan, which appears in my books of accounts initially as a financial liability, must appear in Tom's books of accounts as a financial asset. And at the end of the sequence, we saw that while my net worth decreased by $10, Tom's increased by $10 since he received interest on the loan he had extended to me.